Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, October 31st, 2022. It is 10:47 a.m. Eastern Time, so I'm starting the video as we head into the last trading day of the month here. Here's what I'm going to cover, and I'm going to I won't get too deep in any one because I want to cover everything. These are the things that I've been watching, trading, and posting lately as trade ideas, trading opportunities. We'll start with the major stock indexes like I like to do, and I'm also going to include the Russell, which I believe I did last week. Quick updates on natural gas, crude oil, wheat, lumber. Well, actually, new trade idea on lumber. We recently closed out along there. It's another trade setup now, or trade idea. Treasury bonds, gold, silver, and the U.S. dollar, because those all tie together. So that's a lot of stuff. So let's get going. This is the 60-minute chart of NQ, Nasdaq 100 futures. Remember, on Friday we had a what I call a high probability short entry. High probability of success. We had a very near-term extended rally right smack into resistance, and not just one resistance level. All the major indexes hit resistance at the same time. These are the primary trend lines off the mid-August highs right here. Again, covered on Friday. So there's the rejection. Right back to, I just covered in reverse. I'll show you why. Went home, as I told you, I'd be shorting that on Friday, and took it home and just covered now for a bounce trade. But I'm going to get back in. I could be short by the time this video's over. I'm going to just, play a quick bounce off that level. But I don't, you can't see it in the video. I always forget. You got to zoom in here. There it is. These are the same levels I had on Friday when I covered this chart for you. Posted it on the homepage. About 11,350 right there, and you always want to cover a little bit above support. That's where the buyers will usually step in. But I do think that we're going to see continued drift down into the Fed meeting. My thoughts fundamentally are we had a heck of a rally, technically induced, of course. There was, some things there that, including bullish divergences on the short-term charts and the developments on the longer term, the daily and even weekly charts that I covered recently. But my take is this: how much of a potential Fed pivot, even just if it's the market's been drinking a lot of hopium lately, doing straight up shots and funneling that stuff, and in hopes that the Fed's going to back off or ease off, and maybe they will. That was my whole thing, with going long Treasury bonds and all that. However, how much of that, this is what you have to ask yourself, how much of that's been priced into the 10% or so rally in the Nasdaq 100 off the lows? Remember, we are in a bear market. Number one, don't forget that. Most long-term trend indicators still say that. And even if the bottom was in, we've spent a lot of fuel, if you will, to get up to where we're at right now. So very near term, and I'll show you, another reason. Go to the short-term charts. You know me, I like my 5 and 10-minute charts to kind of hone down entries and exits. Here's a level I've had here as well. This chart was shared last week. I don't believe I've modified any of these. 11.3, about 11.355 as well. And you can see it on the 10-minute chart. Also showed through on the 60. So, that's a pretty good drift since Friday's highs, where we hit that trend line, pointed out as an objective short entry. That's a 2.25% drop. Okay, that's pretty good for one day, especially coming off the heels of such bullishness. So you're going to have dip buyers step in. And again, I'm just looking for a quick bounce off that level. Heck, we pretty much hit the minimum target, which is a bounce back to 11,432. But who knows? Okay, so anywhere from here up to about that next level, about 11,515. And I may pause the video and book profits. I didn't even put my OCO orders in yet, but if things start moving, I will. There's a downtrend line too that very well may come into play, near-term downtrend line. So again, this is just a 10-minute chart. So for your active traders, swing traders, really, you can use the 5 and 10s and 15s and 30-minute charts and even the 60s to hone your entries and exits. But this is really the realm of an active trader. We're going to see, my guess is volatility, some grind, maybe a slight downward drift from profit taking. Well, we already saw that today. I don't know how much more. I suspect some more. But also some rallies, probably just volatility. Markets grind around until the FOMC announcement this Wednesday at 2 p.m. So I'm just going to put up one other level right there. you have, I'm going to zoom in and show you why, and I'm going to actually stop the video and just set my orders. That's about 11,480, and then the downtrend line there. So we'll probably make our way up to the downtrend line, is my guess. And so that's going to be another, well, off the lows there. It's about a, depending if and when we hit it, about a one. That is about a 1.25% bounce. Yep, give or take right there. And that's just, again, near-term active trading stuff. Swing traders should, again, just continue to be, expect some volatility leading up to the FOMC announcement. And then from there, as I said, the market will probably show us its hand. So far, they gobbled up after a sell-off into leading up to Alphabet earnings, and then they bought it up on Apple earnings. But Apple's one of the five, FANG stocks, the former market leaders. Tesla has displaced, long since displaced Meta, but and Meta's left for dead, chart-wise. Okay, let's get away from these short-term charts. Get back to the more significant 60-minute charts right now. And again, that just shows downtrend line. Like I like to say, resistance is resistance until unless taken out. If they pop this before or even after the Fed, you have big resistance up here, that yellow line at about 11,785, which is most likely going to cap any breakout and probably give you a back test of the trend line. Or maybe we get rejected and we come down here. I could easily see a pre-Fed pullback taking us all the way back here to 11,100. But again, it may be in a grindy-like fashion. One thing to note at least on NQ, the Nasdaq 100 futures, we do not have negative divergence. We did, however, as I mentioned back then, we put in a divergent high right here. That was negative divergence. Bearish rising wedge right there on the 60, right? We broke down. We had another run at the trend line, which was a lower low. So far, that sell signal is still intact. And that could lead to more downside. We'll see. We'll see after the Fed. But let me just show you the other charts, and we'll move on to all those other things I want to cover. Unless I decide to make this, yeah, maybe I'll do that. Maybe I'll break this down into just equities. Cover the equity indexes, and then I can cover all those other trade ideas in another video. That makes more sense. I should have done that in the beginning. All right. S&P 500 ES, just again, just a beautiful little trend line, and the beautiful because it comes in perfectly with that Nasdaq 100 NDX or NQ trend line. And again, there was your rally into it on Friday, very extended, overbought, near-term uptrend, but the longer-term trend and intermediate remains bearish right now. And you did have, as I mentioned on Friday, negative divergence on the S&P 500 futures. S&P and really most of the other sectors have led or had better performance in the tech sector lately. That's one reason for the Nasdaq 100 lagging. And I think I know you had a lot of bargain hunters step in after earnings and scoop up those beat down market leaders, on what they perceive to be relative cheap valuations. But remember, in a bear market, cheap only gets cheaper until the bear market's over. But that's it. Again, we're only a stone's throw from breaking out above these trend lines. I just don't think we'd go very far if we do break out before the Fed. Here's a pretty big resistance right there at about 39.80. So my best case scenario pre-Fed, or before the Fed, would be a breakout up to that level followed by a rejection off that level. And it's entirely possible we don't even get that. There's an uptrend line to watch too on the S&P 500, and I think it's I always say this, even if you're only trading the Nasdaq or the small caps, you should always watch the S&P 500. You should always watch all the indexes. And so what you have there is negative divergence. There's your uptrend line now. You have nice, at least 3 distinct reactions. And so that's going to be bearish if taken out. And then there's a big support level below. So these are just the levels to watch. And again, I believe I gave you both these charts on Friday, at least on the Nasdaq. I know I did. And then the small caps. That's one, been kind of out of it for a little while, but I took a pretty good size short on Friday because that one is really set up nice. This is RTY, the Russell 2000 futures. small cap index. There's a bearish rising wedge, complete just like the S&P 500 with negative divergences on the 60-minute chart. A rally right into resistance. That's about 1855. Pretty darn good resistance there. And here's the primary uptrend line off the lows, which is an optimal target. You also have some nice support right there coming in. So whether it's pre or post Fed, I see a pullback coming in there to at least that level and possibly more. Let me show you another chart that I think is pretty compelling, and that would be the IWM. If you look at the fib retracements, we have a massive fib cluster here. So this is IWM. This is a 60-minute chart of the small caps here. There's resistance right there, 183.75, which is comparable to that resistance I just showed you on the futures. You know, we're coming off, like the S&P 500, Nasdaq, we're coming off a divergent low. So again, this bounce was 110% technically induced. You had positive divergences on the daily, 60-minute, and even weekly time frames. And so whether it proves to be the bottom, because again, you can make that case with the weekly divergences, you usually don't get those, or it's going to just be a bear market rally. That's about a 13% rally so far in the small caps. Okay, so at some point, and I think now you're going to start to see profit taking. However, remember, Fed's going to be up on deck this week. They are on deck. And, you know, so you're going to see an increased chance of whipsaws. But if you want to be a purist and, you know, break of this bearish rising wedge I just drew out here, complete with your negative divergences, break of that wedge would be a sell signal, take you down. I'm going to move this line down a little. These are old lines here. I'll tweak it somewhere around there, about 176.90. And I'll really have to sharpen my pencil. There it is. I'd say 173.50. Those would be the pullback targets, minimum targets. But again, this could be, let me show you. It could be the potentially the end of a bear market rally. A 13% rally in a bear market is you know, about. There's no cap on what it could be. I've seen bear market rallies that go well over 20%. But just keep that in mind. The 13 is certainly enough to you know, fully satisfy that bear market rally. And then what you're looking at here are Fibonacci Fibonacci retracements. So that's what I'm trying to say here. And if you look at this, if you go to the daily chart here, you can see this yellow line right here. I'm going to jump back down. I was on the hourly chart. The yellow fib goes all the way back to the left of the chart. That's the all-time high. The end of the last bear market, the end of the last bull market, the beginning of the bear market in the small caps. And that one, so I measured all these lines. Then you had this major reaction high back here in mid-March. That's when late March right there, major reaction high. And then more recently, this reaction high. So you can see this white line comes on that one. The yellow line goes on the all-time high, and the blue line goes on this key reaction high here from mid-August, right? So they all come down to the recent lows. So you're measuring a Fibonacci retracements, and you can't even see it because they're so close. These lines perfectly overlap. You've got all three coming in there. You have to zoom in so tight. There's the 38.650 and whatever else. Let's see, that would be the 38.2 there. So you've got the 50% of this move down. The white line is the 38.2, and then this one here, the yellow line is the, I'd have to turn these other ones off. It comes in as well there. So you have all three of those major reaction highs coming in perfectly right here. So that's what we call a Fibonacci cluster. Not just one, but three key Fibonacci retracement levels. And no guarantees, but it also meshes with price resistance in that 60-minute bearish rising wedge. Excuse me, I'm trying to get this video out so fast I'm tripping over my words here. So that's the case for a short in the Russell right there. And again, this all can change. You know, you can take out fibs. Resistance is resistance until unless taken out. And after the Fed, market's either going to like what they hear or not like what they hear. It's that simple. So I continue to maintain it's probably best to keep things relatively light. If you don't know what you're doing, you're new to this, stay in cash, watch, learn. If you're an active trader, there's plenty of opportunities like I showed you on the 5 and 10 minute charts and even the 60-minute charts until the Fed announcement. You can just play ping pong between support and resistance levels, look for little small divergences on the 5-minute, 10-minute chart. And that's something I didn't mention earlier, why I think there's more downside. We don't even have on the NQs, for example, or just about anything, we don't have divergence yet on the 5-minute chart. That's why I'm playing a bounce there, because it's a pretty oversold run, 2.25% move off Friday's highs. Definitely for me, book some profits, game a little bounce, and then get back in. I think, like I said, I think we'll carry a little higher. I was showing you the 10-minute before, but this is the 5-minute chart. There's that downtrend line. There's that resistance level, and so probably a little more upside, and then more downside, and until we at least get some divergence on the 5-minute chart, I think we'll probably see a continued drift lower in the markets up until the Fed, and then maybe after, we'll see. And since I'll stick with just the indexes in this video to get it out to you, so it's not a make long one, I'll just cover the weekly charts here. This is IWM. This was one of my targets on the weekly chart here. It's good support, and so far a double bottom. We bottomed there back in the June, and then of course recently again moving off there. But as I showed you, this is it's hard to see right now, I'm zoomed in. That's a triple fib cluster right there, fibs from the all-time high, that reaction, all the major, those are 3 major reaction highs. This is where you can look at it in almost waves here. You had this move down so far, and again, so a lot of fib resistance. Also, your key moving averages, turn off all the lines. You see these 200-day, and on this chart, it's a weekly chart, so I have them as a 40-week simple and a 40-week exponential moving average. Again, they're the same as a 200-day, and typically it's bullish when an index is above those, and then bearish once it breaks below. And once you break below those moving averages, just as they act as support in a bull trend, they then act as resistance in a bear trend. Particularly the tech-heavy indexes like the Nasdaq 100 work very well. And so you can look at it that way too. This is so far, every time we've come up, there was a rejection off the 200 simple or the 40-week. There was the break, and followed by rejection, rejection, and rejection. So what starts to change the outlook of the market? Well, of course, not just the small caps. In fact, you put a much higher weighting on the large caps, the S&P 500, Nasdaq 100, but to see those indexes get back above those key moving averages. So you look at the S&P 500, again, broke them right here, gave up the 200-day / 40 weeks back there, back tested there, highlighted as an objective short entry, as was the breakdown there, and again highlighted as an objective short entry there. And we came that counter trend rally and got back into shorts there, swung it down, and look, we're still well below those. So the only time you're typically especially well below those is in bear territory. That was COVID right there, 36% drop in the S&P. The big Q4 of 2018 drop. There was a bear market in many indexes, most sectors. In some indexes that didn't drop a full 20% came very, very close, or at least top to bottom were right about there. And then you had we had this period, more of a deer market with 2 corrections of almost 20% back there. And again, that's the only time you spent below there. Other than that, with exception of these big corrections, if you bought every pullback to the 200 or just stayed long when you're above it and got out of your longs, your 401k money when you're below it, you did very well. You outperformed the market. You sidestepped the biggest drops. But again, this is the last bear market right here. You were above them, the whole bull run up to there. They acted as support. You took them out in early 2000 or late 07, early 2008 right there. That was your, hey, get out of the market opportunity. And if you missed that short or you didn't get out of your longs, the market gave you one last chance right there. You rallied back, tested them, and then rejected. And came close there like now. See, on that third one, remember, I've used that analog. And when you look at right now, we're well below there. Well, not well, but a little bit below there. And so some traders might be eyeing that. And that is, look, it is one of my potential bounce targets. It's not right now. I'm leaning towards this whole thing kind of playing out similar. I'm leaning towards, not betting it hard, but leaning that way still, that this may play out like 2008, where you had a beautiful setup, nice rally off the lows, about a comparable rally, and then they sold into it and the bottom fell out of the market, and then the divergences were taken out. And if so, when you look at back then, go back here again, now I'll zoom in for you and you can see it up close. You can see not only did you have, like I've highlighted quite a bit recently, the failed divergences, put it on right here. Let's see. That was it. See the divergent low right there with the rally that looks just like this when we started rallying, and back then it was about a comparable rally right here off that divergent low. But then all of a sudden, just as that rally looked like it was getting some traction, they sold into it hard, and the rest of the bear market came. Now, the other thing, if you turn off these lines again, back then, is just like now. I mean, so far the parallels they're so similar, it almost makes me think they're not going to work out. Early on, I was confident shorting the 200s. This time around, is this whole thing going to play out exactly the same? Unlikely. It's a different bear market for different reasons, especially fundamentally. Technically, so far, it's almost identical, and that's the scary part. But what I was pointing out is the fact you took out the 200s there. You had that one test, just like we had already on the S&P. It looks almost exactly like this up to this point. And here we are. See, we're still well below, somewhat below, just like we are today. That was, again, 2008. And so all the traders eyeing for a move up to the 200s were denied that entry if that was, again, that was then, this is now. So I don't know. Anyway, short term, long term. We'll know long term. Market's going to most likely show us its hand this week, later this week. Don't overreact at 2 p.m. to the initial knee-jerk reaction, whatever happens, unless it smashes through some key supports and just keeps going, or really rockets through some key resistance levels. Obviously, I'll be giving you some pretty frequent updates come Wednesday. And that's it. I don't think there's much else to add. Short-term charts. I told you this before. I highlighted a bunch of indexes and sectors coming to key Fibonacci retracement levels. Again, this is the previous reaction high on the S&P 500 SPY. This is just a 60-minute chart. But just like the small caps, and I'm sure if I put up other fibs here, you'd probably have a fib cluster as well. So you have a combination of price resistance, downtrend line resistance I showed you on the futures, Fibonacci resistance. So again, that's what made it a very objective short entry on Friday when we hit those levels. And now today, like I said, we've got a pretty good healthy pullback so far in QQQ and the small caps and everything, even SPY. We hit resistance. There's that little bounce. Like I said, probably a little more upside, but there's, from where we hit that level on Friday, yeah, it was more than that in the futures, but in the Qs it was about 2%. Okay, I'll wrap it up here. That keeps this video relatively short at 22 minutes. And then I'll cover those other items. That's natural gas, crude, wheat, lumber, treasuries, gold, and so forth in the next video. This has been Randy Finney with Right Side of the Chart. Have a great day.